Well, hello everyone, and welcome back to the Coldwell Banker Wealth Builder Expo series. I also want to formally welcome our friends and wealth builder partners at Guaranteed Rate Affinity Mortgage, and everyone. However you got here, wherever you are, we're glad you can join us today. If we haven't had the opportunity to meet yet, hello, I'm Chris McGatt, and today I come to you from from a chilly but sunny Denver, Colorado. I'm confident you're really going to enjoy the program today, and you're going to learn a lot in the process as well. As we've said before, if you're an agent or a team member and you're in search of a proven way to grow and protect your personal wealth, well, rest assured, you have definitely come to the right place. At Coldwell Banker, we believe that by working together, we can support you in building real wealth, something you can enjoy and leverage for years to come, something that we call living an exceptional life. Now, rest assured, we deliver on that promise of helping you live an exceptional life by staying laser focused on our core four: production power, coaching to confidence, an amazing culture of awesomeness, and, well, why we're all here today, Wealth Builder. Now, just fair warning, if you're thinking that building wealth is a spectator sport, you might be in for a bit of a surprise. Here's what I know. To get the most out of today's session, you got to plan to roll up your sleeves, engage in the content, and do the work. Listen, building wealth isn't hard, but it is serious business. And to be successful, it requires focus, commitment, and yes, self-discipline. Now, speaking of discipline, if you haven't done it yet, please take the time right now to open a SEP IRA retirement account. Now, remember, we make it easy for you to save for your future with what we call automatic closing deductions. Want to find out more about what a SEP account is, or how to open one, or even how to increase the amount you're setting aside? There's a link you can click right now at wealthbuilderexpo.com, or check out the link in the chat section on the right-hand side of your screen. Both will direct you to a site to schedule a confidential conversation with a SEP retirement specialist. Now, trust me, do it right now before you get sidetracked with life. One of the things I like the most about our Wealth Builder series is that it creates a perfect space to explore your personal finances and your goals. This is a place to have open and honest discussions. Isn't it amazing how most Americans are out there buying things they don't need with money they don't have just to impress people they don't even like? It's crazy. And Wealth Builder is here to break that vicious cycle. As you explore building wealth, I encourage you to stay out of judgment and stay in curiosity. Imagine what could be possible if you had the support, which you do, and you exercised self-discipline. The question is, how badly do you want to change that trajectory of your financial future? We've also discovered that your journey to financial success rarely happens in a vacuum. And that's why we encourage you to invite your support team to each Wealth Builder Expo. That could be your spouse, your partner, and for today's session, I'd recommend even your tax advisor. This is a team effort, so be sure to get your team on the field with you. You'll be more successful if you're aligned in your vision with the people that matter the most to you. Now, not to worry, we'll be recording today's session so you can review it into the future. And yes, getting answers to your questions is at the very heart of why we're here today. So don't miss this important opportunity. It's so easy. If you're joining us on Teams, as you look on your screen, you'll see a Q&A button in the upper right-hand corner of your screen. If you're catching us today on Facebook Live, simply message the questions, and that way we can get in the comment section, that way we can get back to you. Once we reach the Q&A section of the program, our producer, Amy Crawford, is going to tee up all of those questions. We'll answer as many as we can until our time is done. The last time we met, we had the amazing opportunity to spend some time with personal financial expert Susie Orman. Now, she provided us with great strategies and real takeaways. Now, if you've been thoughtful, you've been disciplined, maybe you've taken a few of her many recommendations, I'm guessing you're probably earning more money today. So that brings us to today's topic. Now, it may seem obvious, but every dollar you can save in state and federal income taxes means an extra dollar that you can invest in your future without even needing to earn additional income. Now, it's very, very premise behind what we're talking about today. This idea of tax strategies for the independent contractor may not sound sexy or glamorous, but it's exactly how millions of Americans just like you build wealth every single day. Don't worry about writing down every tip or strategy you hear, because there are going to be a lot of them. Again, we're recording today's session so you can review it again and again and again. In fact, check out wealthbuilderexpo.com for recordings of this and also for our earlier recordings as well. Now, we've assembled a star-studded lineup for you today. From my perspective, They're the Dean Martin, the Frank Sinatra, and the Sammy Davis Jr. of tax strategies. They hail from the great city of Chicago, and they represent the Manning Silverman Company. For over 30 years, they've helped people just like us save money on our taxes. And please help me welcome Adrian Scartu, Joel Manning, and Wayne Silverman to the Coldwell Banker Wealth Builder Expo stage. Gentlemen, thank you for joining us today. Adrian, hello. Let's get started with you.
Good morning, Chris, and thank you so much for the opportunity. It's really an honor to be back here talking to the whole Coldwell Banker family about something that I like talking about, that I recognize not everybody does like talking about, but this time of the year, we all start talking about it. So to begin, I want to start off with one of my favorite quotes, and one that honestly I kind of think about often. It's by Albert Einstein, and he is attributed with this saying, "You have to learn the rules of the game, and then you have to play better than anyone else." So why do I find that interesting? Because the context in which he said it, he thought that if we knew the details of whatever we're working in, of whatever we're doing, we could have a competitive advantage. In a similar fashion, Kobe Bryant, in an interview, stated that he used to read the referee guidebook when he used to be a player, thinking that if he knew what the referees were thinking, if he knew like how they thought, then he might be able to have an edge over his opponents. So what does that mean for you? Now, I don't mean pick up the US tax guide, this beautiful 900-page book, and start going through it to learn the rules. But what I want to tell you is that the rules are in your favor. This very thick book, 900 pages, like I said, is very daunting, but about 20 to 25% of it talks about all of the items that are taxable. And the rest of the book, a majority of the tax guide, talks about exceptions to those rules. So if we know these exceptions, if we know the rules and the exceptions, we could use those to our advantage. With this in mind, as an independent contractor or business owner, what is your largest expense? That's taxes. How true is it that our tax bill is oftentimes the largest thing we pay, the largest maybe one-time payment we might pay all year, and how true is it that we don't like to think about that? So how do we bring this down the right way? By following the rules, using them to our advantage. Now I have here underlined the word right because lately there's been a lot of information going on social media. A few social media influencers started talking about their opinion on taxes. I've watched videos with titles such as "How to Never Pay Taxes Again," "How to Buy a Vacation Home and Write It Off 100%." Now with this, I've even had a few clients reach out and say, "Hey, these look good. How can I apply these?" To which I wanted to say, please don't, be very, very careful, because there's a lot of misinformation going around. But today we want to talk about all of the great strategies, even some of them that might sound a little too good to be true, but what are they and how can you take advantage of them? I had a call to action last year, and I want to have it again. What if we're able to save $10,000 per year, invest that at an average rate of return of, let's say, 10%, over 10 years, that could equal about another $200,000 in our pockets. I think now more than ever that's important. We see the way the economy is going. We hear talks of inflation growing at an alarming rate. So how do we get in front of that? How do we become proactive and keep more of our money in our pockets? Well, it's by being smarter, being proactive, taking advantage of the tax code, or as Albert Einstein would say, knowing the rules and applying them to us. So what are the things we're going to talk about? I want to talk about three big picture ideas and then a few subcategories under them. So I want to talk about run it like a business. We have a business. What do we need to do? Entity selection. We may have heard have an LLC, have this type of corporation, but we might not really know what that all means. There's a lot of different types of entities out there. There's a lot of people thinking different things. So what's best for you? Then the fun one, commonly overlooked tax strategies, things such as hiring our family members, retirement plans, travel and depreciation, looking at these a little bit differently. And one of my favorites, Section 280A of the tax code, that many magazines have claimed this to be the number one most overlooked tax strategy by businesses in the country. So again, how do we use all of these rules to our favor? Well, we're going to go over all of these. And again, just like Chris said, this will be recorded. Do your best to pay attention, take notes. We're going to have a Q&A, and also feel free to email us any questions. We're definitely here as a resource for you. I made this comment last year. We had a number reach out afterwards and answering questions. Very happy to do that and be a resource for the Coldwell Banker team. So the last thing before really diving in that I need to do is give a little disclosure that yes, we are CPAs, and yes, these are all great tax strategies, but definitely consult with your tax advisor how these apply to you. What might work for you might not work for someone else. Or the other way, what works great for someone else might not be that great for you. So let's jump right in. Run it like a business. What does this mean? Well, three things here: documentation, a few things we must do, and best practices. Documentation. This is very much compliance related. And I agree, compliance is not fun. It's pretty dull, but it's very, very vital. We also want to audit proof ourselves in a way. In addition to saving money in taxes, we want to make sure that we're following the rules to be audit proof. So documentation, we believe that accounting or having your documentation in order is more important now more than ever. We're definitely noticing that banks are requiring financial statements from those who are self-employed, going a year back, even 2 years back, to purchase a new home, or even we've seen it for refinancing. If you don't have your accounting in order, it's kind of a scramble to get all of this together to give it to the bank. Government programs like the PPP program or employer retention credits or a few other ones, again, require financial statements going back a year or two. So again, we were able to put these together and do it for many of our clients very quickly. But now more than ever, it's important to, number one, have our documentation in order and start thinking about a process of getting our accounting in order for whenever that's needed. Also, I'm a very strong believer that you need to know what your numbers look like in real time to make better decisions. Should you make that additional purchase? Should you take on additional debt? What's best for you? It's hard to tell when you don't have your numbers in order. Something that you must do, again, very important, have separate bank accounts for your business and for you personally. Why? Because if not, you're in effect piercing the corporate veil. What this means is that if you're mixing your business and your personal bank accounts and credit cards, and the IRS notices this, they have every right to audit both you on the individual side and the business side. Again, very important to have separate accounts for your business and for you personally. And a few best practices. We'll talk about entity setup, but when you do set up an entity, or if you do, it's important to pay yourself a wage from your business. It's also important to file quarterly taxes, pay quarterly taxes, stay on top of these things. Because again, the IRS is looking at these compliance issues. Something that we might not think is very significant could actually be something very important, and we don't want to be questioned for something that's important to the IRS that we think is insignificant. So with everything that we've seen, it's very important to run your business like a business. Have your documentation in order. Have your accounting records in order. Have the separate bank accounts for you individually and the business side. And follow the best practices and have your compliance in order. Then let's talk about entity selection. Again, this is a favorite of mine because you hear a lot of talk about set up your LLC. And if you set up an LLC, you could do all these other things. However, being a sole proprietor, even if you don't set up an LLC, you're still allowed to deduct your business expenses from your business income. So you could run your business as a sole proprietor and still be able to deduct all the expenses an LLC could or an S corporation. However, the LLC provides great liability protection, and I would definitely recommend reaching out and speaking to an attorney to see if you should set up an LLC for that liability protection, to separate your business assets from your personal assets. But here's where the nice thing comes along. The S corporation is an LLC that you select to be taxed as an S corporation. And here's where that's important. If you're a sole proprietor or an LLC, your net income or your profits from your business after taking away all expenses, you have a tax called self-employment tax, or called FICA tax. This is the tax on Social Security and Medicare. So if you were a W-2 employee before, you got your paycheck and you looked at it, you saw federal tax being deducted, state tax being deducted. Social Security and Medicare. You might have also seen that on your Social Security and Medicare, being a W-2 employee, you also had a company match. This is because an employer is required to pay half of the Social Security and Medicare tax for an employee. When you're self-employed, you have nobody else paying that other 50%. So you, the business owner, the sole proprietor, the LLC owner, you're paying that 15%, that Social Security and Medicare equivalent, which is 15.3%. So if your net income or profits from your business to, use $100,000 because that's simple. If that's your net income, your self-employment equivalent is about $15,300. Now, what happens if we set up an S corporation? With the S corporation, you now set up a separate entity that you are acting as both employee and owner or employer. Might sound funny because you have no one else working for you potentially, but you still are treated as both an employee and employer. As an employee, your business, your S corporation, is going to give you a wage, a W-2 wage or a salary. On the other side, as an owner, you're also allowed to take out a distribution. So here's where that comes into play and where it could potentially benefit you. On the wage, if you see here in our columns, if we go down the column, let's say same $100,000 worth of net income, but coming to you as both an employee and an employer, and we just used for simplicity 50-50, so 50,000 of wages and 50,000 distributions. On your wages as an employee, you're still paying that 15.3% Social Security and Medicare tax. But on the distribution side, there's no Social Security or Medicare tax that you have to pay on that. So this scenario here, LLC and sole proprietor versus an S corporation, both earning $100,000 worth of net income, could potentially save about $8,000, again, by just setting up the S corporation. Now, this sounds very good, but there are a few things to think about. Number one, when you set up the S corporation, you have to give yourself a reasonable wage, meaning I can't give myself a W-2 of $10,000, take out $90,000 from the business as a distribution and pay no self-employment or Social Security and Medicare. So you have to talk to your tax advisor to figure out for you, your line of work, and you specifically, what is a reasonable wage and a reasonable distribution. When you do this, you also have to set yourself up on payroll. You have to pay quarterly payroll taxes, and you have to give yourself a W-2. It's something, again, mandatory and that the IRS looks like. So yes, there are further compliance issues to take care of. But if we're able to save, nearly $8,000 in this scenario, how much more beneficial is this to us? Where it may make sense to do all of the other compliance things to save this tax. And as our income increases, so could potentially that split between wages and distribution. A few other things to think about is, as I talked about here, the main savings is by saving on Medicare and Social Security. So if you're someone looking to maximize Social Security, then it may not be worth doing this, or it may be worth doing it, but having your wage still be at a level where you're maximizing your Social Security. When we're going to talk about retirement plans, also some retirement plans for businesses are dependent upon that wage, meaning if the wage is too low, we're not able to put away as much as we want into retirement. So again, very great tax strategy, but how it impacts you could be very differently from how it impacts someone else. Very important to talk to your tax advisor about, should you set up the S corporation? What should your wage be? How can you maximize Social Security? How can you maximize retirement? How can you, do all three? Maximize your tax savings and your retirement contributions and Social Security. It's definitely doable, but it requires having a good plan in place. Again, being proactive, knowing the rules, and how you could take full advantage of them. And this is where it's important to have a good team around you, both tax advisors and financial advisors. So once we set up our entity, the next thing we want to talk about is family. How true is it that, oftentimes our family members work with us? So what should we do? Have them become our employees, formalize that business relationship or not? Well, if our family members become our employees, now things such as driving to the store, they could track those miles. such as if you take a business trip, legitimate business trip, and your family members or your employees and they travel with you, that becomes a deduction as well. But what about college planning? Something very interesting. I want to talk about college planning and how we could potentially use this as a tax strategy. Now, if you're someone who is thinking of paying college for your children, or who's currently paying for college for your children, what you end up getting on your tax return is a credit of no more than $2,000 or potentially $2,500 towards this towards paying college. And if your income is too high, you may even be kind of phased out of that and not get this. But considering that our children might not have any other job, they are going to be at a much lower tax bracket than we are. So we are at a higher tax bracket. Our kids are at a lower tax bracket. If they now become our employees and again do legitimate work for us, we're able to pay them. And what in effect happens, we're shifting income from a higher tax bracket to a lower tax bracket, and then just telling our kids that we love them, we're giving them a job and paying their wage, but they're going to have to pay their college directly. So what happens now? Depending on what that difference in tax bracket is, we're again shifting income from our higher tax bracket to that of our children at a lower tax bracket. They're paying the college. You will not be able to claim that tax credit for the paying college on your tax return because you're not paying it, but your children may be able to if they are independent and if they're paying their college. So again, something very interesting to look at, but not only from the sense of college planning, but also there's some other advantages. Children begin their wealth building journey much earlier on. Another example, one that I like to talk about very often because I thought of it for me personally and I realized how it could affect me. I had a good friend, let's call him Bill, who knew about this, started paying her his daughter in high school, and he started paying her about $10,000 a year. As she got to college, he paid her more so she could pay her college, and his daughter did, again, legitimate work for him. But the interesting thing is, he taught her the importance of putting money away for retirement. So at 15 years old, she started maximizing her Roth IRA contribution, which was about $4,000 or $5,000 at the time. Now it's about $6,000 or $6,500. So he paid his daughter. From 15 years old, she started paying into her Roth IRA. I did a calculation. If she continues that and contributes the maximum amount every year to her Roth IRA, which again is about $6,000, if she did that from 15 years old till the time of retirement, I only started that at 25 years old. So 10-year difference. But that 10-year difference made a difference of about $1 million because of the power of compounding interest and the power of how the retirement plans work. So by her starting to fund her Roth IRA just 10 years sooner than I did, by the time we're both at the same retirement age, she would have, potentially about $1 million more than I would have. Again, a very great way not to just look at tax savings, but also helping our children, getting them in the mindset of building their wealth. So now we're looking at having both the tax advantage and helping our children with their retirement. Another great thing to think about is, again, if our children legitimately do work for us and they're paid just up to the standard deduction of about $12,400, that amount of income that they're receiving, there's no federal tax that they need to pay on that. So again, talk to your advisor to see if your children are actually, working for you already. How do you formalize this and pay them and use this to your advantage? If they're not working for you, it might require a conversation with your family members and again with your tax pro to see how, number one, we could save in taxes, and number two, help our children with their wealth building journey. And I just was talking about retirement plans and how we could take advantage of these for our family members. In the same way, I want to lead right into talking about retirement plans. And why do I want to do that? Because we might think of, the traditional IRA, the Roth IRA. But when we have a business, when we're sole proprietors, even if you don't have an LLC or an S corporation, you're able to take advantage of the SEP IRA, the solo 401k, a simple plan. So these are retirement plans that you're able to set up for your business, and you're able to have a much higher contribution limit, up to $58,000. So again, I paused right there because that's a huge amount of money. $58,000 you're able to potentially put away in your retirement plan. look at a traditional IRA where you could do no more than $6,000 or $6,500. If we, are not familiar with these plans, it's another great way of setting ourselves up for retirement. And the amount of money we contribute, if it's a traditional plan, again, that becomes tax deduction to us in the year that we contribute. If we do a Roth plan, what happens then is you don't get the tax deduction in the year of contribution, but at retirement, you're able to take out that money tax-free at that time. So again, very, very great tax strategy that if you have not thought about this tax strategy before, if you have not been familiar with these types of retirement plans, very important to talk to your tax advisor and to talk to your financial advisor to get these going. Another great thing about these is that if you have these set up for your business, the time to contribute could sometimes be up to the date of when you file your tax return. So what does that mean and why is that important to you? Because you could finish off the year, you could see what your net income is for the year, and then we could kind of take a look and say, okay, what type of retirement plan do you have? How much would you like to contribute? And we could see what the tax benefit is there. So again, very great tax strategy to also be able to see in real time when the year is coming to a close or after the year ends. Great opportunity to see in real time, if I put however much money away for retirement, what is my tax savings going to look like? So before I move on, I want to mention that I hope everyone is seeing how these, not only are they great tax strategies that could help you, but they kind of build on one another, right? Kind of building blocks. We're trying to set the foundation. We're starting a business. We're running it like we should be. We're getting our documentation in order. We have our accounting in order. We see what our numbers look like. We're able to make great decisions that could impact our taxes and just us financially in general. We're able to audit proof ourselves and making sure we have all the compliance right. We're looking at entity selection, liability protection. How do we protect ourselves from a liability standpoint, from having the best, tax advantageous entity? Then we're looking at our family members. If they're already working with us, how can we formalize that and take advantage of the tax code? We're looking at retirement plans afterwards, how they could impact us and our family members. And if our family members work for us, they could also contribute to the business retirement plans. So again, knowing the rules, but not just knowing them. It's one thing to know the rules, but knowing how to use them to your advantage. Travel. Another great one that we might think about travel as, driving to a store, going to an open house, going to network with somebody. But what about if we travel outside of the state? Well, business travel by the IRS is required to be 50% on business-related activities. So half of our day at minimum, and according to the IRS, a business day is 8 hours. So at minimum, 4 hours a day needs to be spent on business-related activity. If we're able to do that and we're traveling out of state, then that trip, airfare, hotels, lodging, things like that, becomes a business trip and you're able to take the tax deduction for these expenses. What about something we like to think of as lifestyle travel? This requires some proactive planning. What trips are we already taking or wanting to take, and how can we legitimately turn them into business travel? Again, legitimate, that's the main idea, because we don't want to put someone in a situation where you're going to Disney World for a full week, you spend one day doing work, but you write off the whole trip saying it's a business trip, and then that could, end up being a negative thing in the future if that was ever to be put into question. Again, we're looking at doing things, like I mentioned, from a compliance standpoint, having all our documentation in order. But what if we do end up being in Florida? What if we could plan ahead and we're going there to a conference, or we're going there and we're spending the minimum amount of time required to network with other real estate agents, to go look at open houses there, to go meet with clients we have down there, to go look for houses for clients we might have somewhere else. Now, again, we're being proactive, planning ahead, having business purpose wherever we're traveling to be able to meet the requirement of a business trip. Likewise, if I was traveling for a conference somewhere and let's say I have a friend in that city or a family member, I'm at the conference all day and then afterwards I get to visit them. Again, as long as I'm there and I have necessary and ordinary and legitimate business purpose, even though I'm seeing family members and I'm able to have a little bit of relaxation, I'm still meeting the requirement for a business trip. So, what type of travel are we already doing or planning on doing, and how can we turn it into a legitimate business trip? Another important thing or interesting thing to know is that if we're traveling and we are out of state over a weekend, again, if we have legitimate business activity on a Friday and on a Monday, it might make a lot more economic sense to stay the weekend, right? Why would I fly to Florida Friday morning, fly back to Chicago Friday night, fly back into Florida Monday morning, and back in home Monday night? No, that economically that would not work out, and any reasonable person may stay the weekend if that's cheaper. So the IRS knows this. So again, if you have business activities on Friday, or let's say Thursday, Friday, and then Monday, and you spend the whole weekend, even though over the weekend you might not be doing any business related activities, because of that, you're able to airfare and lodging write that off as a legitimate business expense. So you're able to stay the weekend because you're much better off financial position staying the weekend. The IRS agrees with that, and this is another nice thing where knowing this rule could play in your favor. Moving on from travel, I want to talk about depreciation. So again, big accounting word, but what does this really mean to you? Well, in the 2018 tax update, something interesting happened where the IRS actually allowed any vehicle or business vehicle of 6,000 pounds or more to be fully depreciated. So what does that mean? When you depreciate a business asset or a vehicle, because this is what we're talking specifically here about, you're writing it off over a specific amount of time. So you buy a car for $100,000, auto depreciation rules, you write that off over 5 years. But what they allowed is if the vehicle is 6,000 pounds or more, you're able to fully depreciate that in the year of purchase. So in our example here, you buy the Cadillac Escalade, you're able to write off 100% of that vehicle in the year you purchased it. So let's say your net income was, of a high number, and you're looking to buy a new car. Just the type of car you buy could have a big impact on you. Now, here's where it's important to talk to your tax advisor. There's definitely some things to watch out for. The expense in the auto has to be ordinary and necessary. So again, we're trying to become, watching out for compliance reasons, not to break the law. It needs to be ordinary and necessary, meaning if, we made $30,000, it's really hard to justify buying a $50,000 car that year when our net income might be very small. Or if we're only driving 2,000 miles per year or 3,000 miles per year because we're not driving very far, again, if questioned, it might be very hard to justify why we need that $100,000 Cadillac Escalade. Another thing to watch out for is if we're fully depreciating that automobile and claiming that its value is zero, if we were to trade in or sell that car after a year or two and get trade-in value or sell it and make money, that now becomes a gain or income because we're selling something that we're telling the IRS has no value at all. So again, another very interesting rule that's a good tool to have in our toolbox, but again, something that we need to watch out for and see how it could apply to us. Moving on to Section 280A, which I mentioned is definitely one of my favorites, and mentioned even by Inc. magazine to be one of the most commonly overlooked tax strategies by business owners. So Section 280A is just a section of the tax code, that great 900-page book that I just held up earlier. So before talking about this, I want to ask a question. And I love talking about this and posing this in this way. How much more efficient would you be if you were to take a day a month to work on your business and not in your business? Taking that day per month, meeting with your team, and working on your business, talking about your numbers, talking about your marketing plan, just planning for the following month. Or taking a day per month and working on your business in the sense of having meetings with your clients, doing presentations, giving a market update, things like that. Just taking a day and not going through what we do every day, but doing something different that could benefit us. I think we would all agree that that's something very beneficial and that could help us. So what would we do if we were to have a client-facing presentation, or if we wanted to meet with our team members and we wanted to maybe get out of the office to go have some quiet? We might rent a meeting venue for half a day or maybe for a full day. We might have our meeting there, or our presentation there. Now, let's keep that in mind, keep that in the back of our minds, and talk about Section 280A. This is also known as the Augusta Rule because during the golf tournament, a lot of people just petitioned Congress and said, all of these golfers are coming and renting our houses and we're paying a lot of money in taxes on this, but we're not really rental property owners. So the IRS came out with a rule that said if you rent your primary residence for no more than 14 days, so 14 days or less, the income you collect is not going to be taxable income to you. So a lot of us might not want to go out and rent out our house, but let's think about it a little differently. That meeting venue, instead of renting a meeting venue, our business now rents space in our home. So we do that for 14 days and we get a fair market quote from a few meeting venues and see how much that costs. What if it's $2,000 a day? Or what if it's $5,000 a day? Now that meeting happens at our primary residence. We have this meeting where we're working on our business, not in our business, and our business is paying rent to us. So in effect, we're shifting income from the business to us following this rule, essentially tax-free. Again, really great tax strategy to think about and one that could have a lot of money in your pocket. So now I just want to go back and summarize all of the things we talked about. Run it like a business, making sure we have our documentation in order. Entity selection, let's see what works for us. We talked about commonly overlooked tax strategies, hiring family members, talking about retirement plans, looking at travel depreciation in Section 280A a little bit differently. Again, I hope we see how these all build on one another, how some might be right for you, but not for someone else. So it's important to talk to your financial advisor and your tax professional to see how you could implement all of these together. So again, my call to action. How would an additional $200,000, if saving $10,000 per year invested over 10 years, how could that impact us? By being smarter, being proactive, not working harder, and really just taking all of the rules and applying them to us. Before moving on, Joel, I want to just throw it out to you, and if you don't mind giving a real life example of how we've implemented these to a client and how it could be beneficial to them.
Thank you so much, Adrian. And again, Chris and your team and everybody at Guaranteed, Ray, we just want to say thank you for having us here today. So what have we learned? Let's discuss the tax strategies that Adrian had mentioned. Let's have fun. But let's remember what we're really here about. We're here to not only just have fun, but we're here to save thousands of dollars. What I want you to know is at the end of this, we'll have plenty of time for questions and answers. And if we run out, if you look at the bottom of the screen, you'll see that you can just ask for questions by emailing us. We'll answer everybody's questions. That's the real purpose we're here today for. Remember, we also don't want to have a tax preparer. We want a tax advisor. We want somebody who's really invested in our business, somebody who's willing to spend the time to think of these strategies that Adrian's been talking about. So let's get into them. Remember to hire family members. If you hire your spouse, if you hire your children, remember the expenses that they have. If they're driving to the store to pick up supplies, if they're putting up those real estate, open house signs, if they're at the open houses, if they're sitting here and they're, doing work for you, maybe doing the bookkeeping in the background, the automobile expense for that spouse could be thousands of dollars that you're leaving on the table. Why not think about deducting them? Too often what we hear is we hear from everybody who tells us things that just aren't true. They say, well, you can't deduct two cars. Well, of course you can deduct two cars, especially if you have two people working for you, or three or four. So it could be your wife's car, it could be your kids' cars. Let's also think about that SUV that Adrian talked about. It could be something that you buy for your spouse and or yourself, and just think of how large those expenses can be. Don't buy a car unless you need it, but at the same time, think about it. Traveling with your spouse. If you hire your spouse, if you hire your kids, that family vacation that you were taking to Florida could be something that you'll end up getting a full deduction for. And why not? You could be looking at properties there. You could stop at another real estate office, or you could just be having your board meeting out in Florida instead of here in your hometown, which mine is Illinois. The same thing with deductible, the airfare, the car rentals, the hotels, tips, meals. All of these things are deductible. the same as if you're hiring your kids and not just your spouse. If we hire our children, the first $12,400 is tax-free. Think about it. You get the deduction, and your kids pay no tax on that $12,400. Document your business trip, as Adrian talked about. And what do I like to do? I like taking pictures. I have a cell phone. It's always with me. I always say to myself, if I'm sitting at dinner or I'm out at a meeting in another state, even at dinner at a local restaurant, just pull out a piece of paper that has a little bit of an agenda of things you're going to talk about. If you're like most people, I think what you end up doing is you go out to eat with your spouse and or your family, and work always creeps into the discussion. Why not formalize it? Talk about retirement plans. Adrian was being very, very kind by saying if you could put away $10,000. What I'm telling you is if you implement all the tax strategies that Adrian's talked about, the amount of money you should be able to save is many tens of thousands, if not 100,000. With that, I strongly urge you to put at least 50% away in retirement accounts. Think about it. Think about it. If Adrian said at 10,000 over 10 years you can get to 200,000, at 50,000 we can get to $1 million. That's in 10 years. Change it to 20 years, 30 years, and start looking at really creating massive wealth. We talk about paying your kids, and Adrian talked a lot about college. Let me just give you that real life example. If you're thinking about paying for your kid's school, whether you're paying $1,000 or $30,000 for tuition, most of us, husband and wife, once we get over that $150,000, we fill out that awful form called the FAFSA. And what we find out when we fill out that FAFSA is that $150,000 of wages between, both you and your spouse don't entitle you to get anything. The IRS does the same. We don't end up giving you your tax credits for college and everything. But if your child ends up paying for it, your child does get the credit. So let's think about it. We give our child $30,000. Our child pays for his school or her school. They now get the tax credits. The first $12,400 that you paid them out of that $30,000 is tax-free. They're paying little amount of tax instead of you paying on $30,000, probably somewhere in the range of $15,000 in tax. I pause because I really want you to think about each of these ideas. What the government is giving you, what you are allowed, is not just what you tell somebody and they put it on your tax return. What you're allowed with just a little bit of planning, just a little bit of thinking, is over 50% off on all these items. It is like the government gave you a coupon that you don't have to walk around with. 50% savings on each of these ideas that Adrian was sharing with you and I'm talking about right now. If you had a spouse and a couple of kids, obviously if you had more kids, it'll be more, but just think these ideas could save you $100,000 a year. And I'd be happy to sit down and show you how it can be done. So at $100,000 a year, putting away that $50,000 into retirement is just something you need to act on now. And if you could afford to put even the whole 100 that we save you because you didn't even plan on getting that 100, it would even be better. It would make me very proud that we would be able to really help you create wealth. The purpose of today's meeting at Wealth Builder. So now we'll talk just a touch on that 280A that Adrian talked about because it is our favorite thing to talk about. If you're having a meeting in your house, go to a hotel, go to a country club, find out what it would cost, get a proposal from them, what it would cost for a day at that hotel or that country club. It has to be a fair market value. So let's say we find out that we could have breakfast, lunch, and dinner, snacks, a premium open bar. Maybe we even have our guests spend the night. We have linens on the table and we have flowers on the table because, well, it's just very nice. It looks really good. We have use of media equipment. Each of these things I'm adding just does one thing. When you go and you get your quote from that hotel or that country club, you've helped increase the value. Instead of having something as simple as just a party or just a meeting, I should say, at a hotel and use of a room, and they say it'll be a couple thousand, find out what it costs. Many of you have already had events at hotels and country clubs and restaurants, and you found when you had an event for your family or a wedding, you found how expensive it was. Well, now ask them. I'm having a meeting. I'm having my accountant, Joel Manning. I'm having Chris there. I'm having Adrian there. I'm having 15 or 20 of my clients there. So we're going to have 25 people. What does it cost for 25 people for breakfast, for lunch, for dinner? Have snacks. We want a nice room so people can get up, move around, exercise a little bit so that it's not so boring. So I hope we're keeping you enlightened here. And in addition, media equipment. In addition, linens on the table, flowers. You'll find out for events like that, it could be $5,000 or $10,000. $10,000. You're allowed up to 14 of these meetings a year. Could be $140,000. What does that mean to you? It means your company could write a check, just like it would be writing a check for any bill you have, to you. It can write a check to you for $140,000, and that money to you is tax free. So what I want you to really understand is it's not just a tax discount, it's not a tax deferral, it's free money. So when we hear about all these celebrities or these people who earn lots of money, and we hear that they pay little or no tax, this is one of the big items that they use. I want you to have that same ability that they have. What I want you to think about is hiring your family, traveling, their cars, college, retirement, and the Section 280A. If we could start implementing all of these for you, or your tax advisor can. So I'm happy either way. I just want to make sure that you get this benefit. You'll find that you can be saving that $100,000 or more that I'm talking about. You always want to make sure that the hotel or country club you use or restaurant, it's always something similar in fair market value to your home. So if you have a beautiful home, have a beautiful event at a hotel or country club or restaurant. If your place is a smaller condo, well, don't think about that beautiful hotel and that beautiful country club, but something maybe a little bit more reasonable. Fair market value is important. In addition, you can't deduct your home cost for a home office at the same time you do this. It's one or the other. I will tell you that Section 280A, as Adrian did mention, Inc. magazine has said it is the number one most overlooked item not taken by people. Most of the reason is most tax people don't even understand it. So you really want to go to somebody that does. I want you to have the savings. I want you to enjoy this wealth. I want you to enjoy the journey. I did want to touch on two other things today because they're really affecting your business. The first is a 1031 exchange. Sometimes people refer to it as a starter trust. And basically what that is it allows you to sell a property or multiple properties and replace it with a property or properties of equal or greater value. And what that does is it lets you sell more properties because when a client buys a property for $200, it's now worth $500. They have a $300,000 gain that they have to pay taxes. If we put it into a 1031 exchange or a starter trust, what happens is they don't have to pay the taxes today. We get to defer them so they have more money to buy more property, which puts more money in your pockets. And that's something that we really, really want to be able to help you with. If you have somebody who's thinking of selling a property, we can help you and describe what a 1031 exchange is if you don't understand them. And we can help walk you through it. So how you can end up helping a client buy more property with the same monies and end up helping you earn larger commissions. In that 1031 exchange, I also just want to mention that it's possible we could be selling those properties indefinitely and never pay tax. Think about buying a property for $200, it's now worth $500. Buying something for $700, it's now worth $1 million. And at the end of the day, we had hundreds of thousands of capital gain. And upon our passing, those properties transferred to our children at the fair market value, a stepped up basis, and we have absolutely no tax on any of those gains. These are the things that we really want to be able to spend time and teach you, and we really believe your advisor should be doing the same. None of us need a preparer, we need an advisor. And the last thing I want to talk about is something brand new here in Congress. It's just recently starting to be talked about. But for any of you that have any employees, there is something called an employee retention tax credit. You'll hear more about it being referred to as an ERC. Let me describe what that is for you. What an ERC is I am able to hire, or I'm able to take employees that I have working for me that aren't related to me. So now we're not talking about our children or our spouse. We're talking about other employees that aren't. And the government is giving us, for retaining these employees, a check for $26,000 times each employee. Let's just say one of you had an office and you had 5 employees. 5 times 26 is $130,000 less whatever you received in PPP money previously, but only the portion for employees. So let's just say, for example, in the past you received $6,000 in PPP money for one of your employees, and today you can qualify for $26,000. You'd have an extra $20,000 for that employee, or in this particular case, $20,000 for all 5. This $100,000, or this, in this case, this $100,000, the government is giving to you free. It's just free. So I want you to be aware of it. I want you to know that it's available. I want you to feel free asking us how you get your share of the money. I want you to feel free trying to understand more of it. There really is nobody that I feel more comfortable with than my partner Wayne and my partner Adrian. You'll hear from us on questions and answers. If you have any questions, I think you'll find we can help you through the process. I would love more than anything for you just to call us up if you have employees and just say, hey, how much would I earn? There's no cost. There's no nothing. We want to give you the analysis. It's our way to repay Chris and his team for everything they do for us. It's our way to say thank you to Guaranteed Rate for allowing us to talk to you today. So Chris, your team, Guaranteed Rate, we just want to thank you today. We greatly appreciate everything. And now back to Adrian.
So I started off with a quote, and I want to end with another quote. Again, we're from Illinois, from Chicago, so why not end with a quote from Michael Jordan? Get the fundamentals down, and the level of everything you do will rise. Similarly, think about that with your finances. Get the fundamentals down, and the level of everything you do will rise. Chris, at this time, I want to throw it back to you. Be happy to jump into Q&A.
Great. Adrian, Joel, thank you so much for providing us with so much actionable information. So this brings us to our favorite part of the program, the Q&A section, where we get to hear from each one of you. Now remember, type your questions into the Q&A box on the upper right-hand side of the screen, and we're going to call a quick audible because this is such great information. And we've been just like swarmed with questions, which is just what this is all about. So Adrian and Joel and Wayne, if you're accommodating, if you can do it, we're going to run about probably 10 minutes long today. But let's get started. Get your questions in the Q&A box. Amy, go ahead and send over the first questions. And we've got a lot of them, and they're just great questions. Let's start out with a question from Kelly. For the IRS, how long should I keep returns and supporting documents for possible audits?
You want to take that, Wayne?
I'd be happy to. The IRS requires you to keep your supporting documents for a period of 6 years. Since you're always in a current year plus the 6 years going back, our general recommendation is to keep the documentation for 7 years, and that would be sufficient. In addition to the supporting documents, our recommendation is keep the tax return itself. My recommendation is generally for a lifetime. Back in the days when everybody had paper tax returns, I tell people you can keep a lifetime of tax returns in a single baker's box. Now everything's kept electronically, so on one file on your computer drive, you can keep a lifetime worth of tax returns. No reason not to have them if you need them.
Excellent. All right, this is from Silva. My understanding is that the DRE, the Department of Real Estate, I assume, does not accept an LLC for doing business as an agent, but only a corporation. Can you please confirm this? Now, this may be state specific, so it may not be relevant for everybody. But what is your knowledge about LLC versus S corp as a real estate agent?
Adrian?
Yeah, definitely. We have seen that in a few states. So it is state by state specific, where certain businesses are or are not allowed to be LLCs, S corporations. There's other types of LLCs and corporations as well. So that is definitely a situation where talk to your tax professional, or if you have any further questions, feel free to email us. But it is state by state specific. So again, this is why I said what could work for one person might not work for another person. So again, state by state specific.
Excellent. If you're joining us late, just so you know, we're going to run until 10 after to make sure we get more questions answered. Joel, go ahead. You're going to add to that, I think?
Yeah, I was just going to say that if your state doesn't allow the LLC, the S corporation will definitely work just the same or just as good to solve all the things we've talked about today.
Excellent. All right, the questions are rolling in. What is the minimum income and commissions you recommend that I earn prior to setting up an LLC?
I would say I would recommend setting it up on any dollar that you earn. The first thing we always want to make sure of is, God forbid, there's any liability. Once you have a corporation, I know most of you have insurance, but in addition to that, once you have an entity that you set up, you'll also have limited liability. And it's that limited liability I always worry about. We never know. Somebody that works for us might be doing an open house and accidentally leave the stove on, cause a fire in the house. God forbid somebody gets hurt or something like that. We always want to have you protected. So the entity selection will really help you no matter how much money it is. In our office, for tax purposes, we generally say at least 10,000 in commissions, but I really like to say $1. I think it's smart to set up the corporation, and I always find that when people do set up a corporation, they get more serious about their business. We start having more discussions about their business. The wealth starts building, and the business starts growing.
Great advice right away. This one comes from Amy in Florida. If I purchase a car that's not 6,000 pounds and I wrap that car with advertising all over it, can I deduct the entire cost of the car as an advertising expense?
Wayne?
Do you love how creative agents
Unfortunately
are?
not. Yeah, the answer to that is unfortunately not. That the car itself is specifically given in the code, and the car itself has to be depreciated rather than expensed all up front. However, the cost of the wrapping and the cost of maintaining, driving it, insuring it, etc., because that's all being used 24/7 for business purposes, is going to be deductible. So your ongoing costs will be deductible, but the car itself will still have to be depreciated.
Great, good clarification. Question came in here. It says, is general business insurance and E&O insurance tax deductible?
The answer is yes, it's tax deductible. So everybody should be deducting their insurance and uh, they should always be planning on deducting every business expense they even think of, letting us talk to them. But yes, it is deductible.
Okay, great. And from Cheryl here, if I'm already drawing Social Security, does it make sense to take the least amount of wages allowed if I form an S corp? I mean, yeah, I'm sorry, an S corp.
Wayne?
Again, it depends on facts and circumstances. So there are people we see that are already collecting Social Security that may be able to increase it. If their wage base previously was lower and now it's higher, you could actually get more collection in Social Security, but those cases are few and far between. In general, if you're already collecting Social Security, having a lower wage base will result in lower Social Security and Medicare taxes on a current basis, and tends to make more sense. But again, case by case, let your tax professional evaluate what's best for you.
Excellent. This is a softball for all of you. Can you recommend how I find a good tax advisor?
Adrian?
uh, Questions at manningsilverman.com. We're more than happy to be not only a resource, but if anyone needs a tax advisor, more than happy to talk to you and work with you.
Excellent. I thought you might handle that one nicely. Can you please repeat? This is a question that came in. Can you please repeat what specific sorry, let me read this more carefully. What specific questions should I ask my CPA, starting with, should I switch my business from an LLC to an S Corp?
So the answer to the question is, again, on a case by case, but if you're a sole member LLC, we strongly suggest the LLC just make an S election. Very simple. And once you make the S election, you actually will be operating like an S Corp. So we strongly recommend that in all cases to save Social Security, unless, going back to that Social Security question, we have an older individual, and we think that maybe paying Social Security could be advantageous to them to getting collecting more Social Security. Otherwise, we strongly suggest you make that election.
Great. And this one came in from our Facebook live stream right now. It says, do we need to be a broker to set up an LLC?
Adrian?
No, any business. So really, any type of business that you're running, highly recommend being the LLC for the liability protection, and then looking at it a step further, being the S corporation for the tax advantages. But these are definitely available to any type of business, any type of sole proprietor. Let's say you might be running more businesses. You're a real estate agent, but you also do property management on the side or run, I don't know, an insurance company. You could definitely set up an S corporation or LLC for each of your businesses.
Great. Can I pay my grandchildren under your college planning suggestions?
Wayne?
The answer to that is definitely yes. The thing you just want to be careful of is that they're providing some services to you and your business. And I think it's a great learning experience for you to mentor the grandchildren and to bring them in and let them see what you do and have them do some filing for you, maybe attend some open houses for you, put up signs, etc. But as long as you're putting them to work and they're providing services, as Adrian said, and then Joel reiterated, that the first $12,400 that these grandchildren will earn is completely free of federal taxes. It makes all the sense in the world. Then anything above that you're paying, and they're paying for their own college. They're going to get the college tax credits for it. It's a win-win for everybody. I strongly recommend it.
Boy, that makes a huge impact. Listen, this is from Patty, and let's stay on the same topic. Does paying your employee college children potentially impact their financial aid qualifications?
Adrian?
Yeah, so again, case by case, but if you were to pay anyone college age, I believe that when they fill out their FAFSA, it's been a little while for me since I've done that, but when you fill that out, they do have to show what income they have. So any taxable income or any income in general to anybody applying for college, they will have to report that. So it could affect them one way or another.
Okay. Love the creativity of real estate agents. From Patricia, I bought an RV and I work from my RV. Can I deduct it?
Wayne?
The answer is definitely yes, if that's your place of business. Again, if the RV is over 6,000 pounds gross vehicle weight, it sounds like, as Adrian had mentioned, it's going to qualify for immediate deduction rather than have to be depreciated. So there's a lot of advantages to that. But yes, if that is your place of business and it's being used solely for business, absolutely tax deductible.
Excellent. This is from Kelly. If I already have a 401k, can I still pay my children? My 401k states I'm the only employee.
So I think in that particular case, Kelly, what we would need to do is talk with the financial advisor and change the plan. So, for example, if you have a plan where it's only for you, for example, I'm speculating a solo 401k plan, you'd have to change out of a solo 401k plan and maybe move into, say, regular 401k plan. So it's not significant of a change, but it is something that we have to make the change. And we could talk to your financial advisor about it.
Excellent. This is from Nakia. What are your thoughts on using HSAs in your tax saving strategy?
Wayne?
Definitely something that's good. An HSA plan has to be coordinated with an HSA eligible health insurance plan. So this is one of those things, work with your tax advisor, work with your health insurance agent, make sure that you have an HSA eligible health insurance plan, add the HSA component onto it. Excellent source of an additional tax deduction.
Excellent. We've got time for one more question. We probably have 100 or more questions teed up here, so we could go on all afternoon. So thank you for bringing us an incredibly relevant conversation this afternoon. But let me just see here. This is from Diana in Florida. If I start with an LLC for 2022, does it need to be on my business cards or an S corp? Does it have to be registered on the business card?
It does not have to be on the business card. I strongly probably would put it on the business card, though. Just for example, the XYZ Incorporated, just so that it lets the world know that there is limited liability. I mean, that's one of the things that I would strongly encourage. I do want to say, everybody that has a question, please know if you send it to us, we will answer every question. We're really happy to have this engagement with all of you. And we're really glad that you've all listened, and you have, I go along with Chris, you have some great questions, which means that you're thinking the same. How can I create wealth?
Joel, thank you for that very, very generous offer. We really appreciate that. A huge Coldwell Banker thank you to each one of you for your time, your sage advice, your expertise, your passion in an area that is, quite frankly, a little vague for many of us on the other end of the screen, but obviously you've got a great depth of knowledge. We really, really appreciate your time today. Thank you. Listen, before we wrap up today, I want to remind each one of you of a proven strategy as you embark on your journey to building real wealth. Here's an example. At Coldwell Banker Realty, we call it Rewards, and it's offered to all of our 48,000 agents. Now, Rewards was designed to provide you with a reoccurring secondary income stream. That's right. Think of it as mailbox money that generates income for years to come, just by doing what you do anyway, telling your friends, your real estate co-op agents about our amazing company and how they can earn more money simply by affiliating us. This video actually probably does the best job of explaining it. Go ahead and cue the video. Well, it could be much easier than that. Now, speaking of agent benefits, valuable benefits for the independent contractor, don't forget that federal open enrollment period is happening right now. This is a time to review your healthcare choices, reassess the needs, and select what's going to be best for you and for your family for the upcoming year. And again, this opportunity ends on December the 15th for coverage beginning Jan 1, with an extension until January the 15th for coverage beginning February 1st. Coldwell Banker proudly gives you access to two great benefit choices, Spark and MGA's voluntary insurance plan called VIP. You can find the links at the start of the chat on the right-hand side of your screen, or just go visit wealthbuilderexpo.com for all the details. And I'm guessing by now you know better than anybody else that today's session wouldn't be complete without a word from our partners and friends at Guaranteed Rate Affinity Mortgage. Check out this cool video that tells a story about what makes GRA so unique and such an incredible partner.
We are Guaranteed Rate Affinity, a group of slightly obsessed mortgage-loving men and women. We represent a joint partnership between the third largest retail mortgage lender in the US and the most trusted name in real estate. And because our loan officers have direct access to the best real estate agents in the business, we create a completely seamless home buying experience from pre-approval to popping the corks. We also unite the industry's most advanced technology platform with unmatched expertise to make the home buying process as simple, smooth, and awesome as possible. Which explains a lot, like why homebuyers love our easy-to-use digital mortgage, which can have you ready to make an offer in minutes. Plus, we offer great tools like Loan Status Monitor, which keeps everyone in the know, and Flash Close, which can shorten closings from hours to minutes. And we have over 100 loan products, with some of the top-ranked loan officers in the country to guide you to the perfect one. And with our mobile technology, help is never more than a call, click, or text away. Because we believe that fully embracing our real estate agent partners, we're able to provide our customers with the best home buying experience available anywhere. And helping you get the home of your dreams with absolute confidence is what we love to do. Guaranteed Rate Affinity. Believe you will.
A great partner creating a great experience. Well, that's a wrap for today's session. Spend less on taxes, more on you, presented by the Manning Silverman Company. I'd like to thank the entire Wealth Builder team that made today's session possible. And of course, a big Coldwell Banker thank you to Joel, Adrian, and Wayne. And just a reminder, additional information from today's session and other exclusive resources can be found at wealthbuilderexpo.com. And we look forward to seeing you in February as we explore proven strategies to help you buy your first or next income property in today's hot real estate market. Another Wealth Builder Expo exclusive. But until then, I'm Chris McGann, encouraging you to stay focused, stay disciplined, and stay committed to ensure that your best financial years are just around the corner. Thank you again for joining.